Hello, everyone. Again, a pleasure to connect with all of you in this episode of ICICI Prudential Taraki Talks. Today, we are going to be covering an NFO on the ETF side, and we're very happy that this is the newest addition to our sector thematic ETF bouquet. And I'll obviously elaborate on the bouquet as we go along. But let's just jump into the discussion today on the ICICI Prudential FMCG ETF. FMCG, as you would all know, is essentially fast moving consumer goods. In very simple words, these are products which you and I consume day to day from morning to evening. These are quick off the shelf items, and we spend almost half of our consumer spending in India is spent on these fast moving consumer goods. Essentially, it covers everything from milk to groceries to packaged foods, etc. And of course, if you see from a very connect perspective, all of us can connect from morning to evening with each of these items, right from the beginning of the day where we are using the toothpaste to moving towards having a nice coffee or tea, as the case may be, whatever you like. Of course, tea and coffee with a few biscuits, followed by, of course, using the shampoos and the soaps to fresh ourselves, and then, of course, moving on towards the cooking oils, the pokes, etc. So the entire entire range of fast-moving consumer goods is something which will get covered or is getting covered through the ICICI Prudential FMCG ETF. There is 15 stocks in this particular ETF, which is tracking the Nifty FMCG index. And as we know, of course, that in India, the consumption of goods and services both are likely to increase with a rising middle class population. And in overall, also, if we see, India is one of the countries where the population is increasing. So not just the population increasing, but along with the economic growth, the demand for these basic goods and services within the fast-moving consumer goods segment is bound to see an uptick. And the good news is that, of course, the rural India, which for the last 10-15 years has been growing well, because of a likely normalized third consecutive year of monsoon, the rural economy is also likely to see a bounce back, and along with the urban economy bouncing back after the COVID. If we put both these two together, the fast-moving consumer goods segment will probably see better next 2 to 3 years compared to what has been in the last 1 year, which has obviously been bogged down because of COVID or the pandemic. India itself, if we see in terms of the FMCG sector, it is the fourth largest segment in the Indian GDP. As we all know that these are, while they are low ticket items, but the mass consumption across the segments, across all the population, means that the companies within this segment are household names. After seeing 1.5 years of market rally across all cyclical segments, this sector, of course, which had done very well prior to that, has had at best a steady year, while the cyclicals have done better. So from a overall portfolio construct, if we see investors who are looking at diversifying their portfolio and having a concentrated exposure to FMCG as a segment, they can look at investing in the FMCG ETF NFO. The NFO has already started on 20th of July, and it is going to end on 2nd of August. The minimum application amount in the NFO is rupees 1,000, and we believe that via this ETF, you get an exposure to the 15 stocks. And like I said, these are household names, the names which probably will resonate with all of us. And if we see the index also from a long-term perspective, it has managed to deliver reasonable returns over a long period of time. So especially in the Indian segment, with digitization increasing, the availability of these goods and services in terms of their penetration is also increasing. And I think the collaboration which these companies are doing along with the digital platforms, which act as an intermediary, is going to probably help the growth across India and in a wider manner. So I think this segment, which is the FMCG segment, should form part of all investors' portfolio in the long run. Arguably, many would say that the valuations of the FMCG segment are a bit expensive, and I won't deny that. The only thing is that from a long-term growth perspective, this segment is relevant from an Indian perspective. And the reason why also the valuations look slightly expensive for the FMCG segment is because the quality of these companies in terms of their return on capital employed, return on equity, in terms of their matrix, in terms of their health, is pretty good. These companies do not need a lot of capital to grow. They do not need a lot of investments to grow. And hence this entire opportunity, which we are basically going to see Indian economy going from 3 trillion to 5 trillion, consumption is going to be a large part of it, as we have more than 130 crore people. And with this consumption being large part of it, FMCG segment will tend to benefit. And the good news from these companies' perspective is that they do not need to keep on investing a very large sum to capture the large part of the growth which is going to come. So because they are not very capital intensive, their valuations are slightly higher in general as well. And in the last 1.5 years, with the markets having rallied from the cyclical perspective, the relative valuations of these companies are not very expensive relative to the market. So the gap has narrowed. So investors who basically invest in the NFO and also keep on accumulating it with a long-term view will get the benefit of the growth in the Indian FMCG segment. And if we see, if you look at the index itself, the top 5 names within the index are household names: Hindustan Unilever, ITC, Nestle, Tata Consumer Products, Britannia, Dabur. This is as on June end portfolio. And from a construct perspective, like I said, these are companies which are known to all of us. They are very well known across the board because of their presence across India. The index itself, like I said, in terms of its performance, because India has been a growth story for long and more middle class population is coming and consuming more, this segment has seen a steady growth. And foreigners, when they look at India, because these companies have a long-term growth potential, they come and buy it, and they have a very large holding in these companies. So most of these companies within the FMCG space are MNC companies or are companies in which foreigners have a stake. We as Indians, of course, should also participate in our own growth. And with that aim in mind, we are bringing the ICICI Prudential FMCG ETF as one of the options to invest in the fast-moving consumer goods segment. It is clear that India, with its growing changing in lifestyle, is going to see a very rapid growth in consumption. And with the rural and urban, both engines firing, along with the government expenditure which is happening, which should also help incomes grow across the board. Like I said at the beginning, we firmly believe that from an investor perspective, we at ICICI Prudential Exchange Traded Funds want to provide you with options which suit your requirement based on your risk appetite. And the ICICI Prudential FMCG ETF is one such new fund offer, which we believe at this time, from a timing perspective for the long term, can be a good addition for those who are looking at investing in equities. We all know that with the prices of goods and services going up because of the easy monetary policy that is there in the world, easy liquidity, the choice with investors is not to keep the money in hand. You have to invest somewhere. And then you have to invest that money somewhere in some assets. If you can find a good balance between, let's say, cyclical and defensive, within the defensive part, at least in the Indian context, the FMCG has proven to be defensive along with healthcare and information technology. So information technology, healthcare, and FMCG are 3 such segments within the Indian economy which are considered as defensives, and not surprising because information technology is a very large outsourcer. Indian companies are very large outsourcers. And to that extent, because the companies are very large outsourcers and they have a good business model, their balance sheets are clean. They've been proven to be defensives along with healthcare and FMCG. So from an investor perspective, we believe that our platform, which is the ICICI Prudential Exchange Traded Fund, provides you with the opportunities across all segments. If I look at the sector or thematic based segments where we already have our products, we have the bank ETF, the private bank ETF. We have, like I said, the IT ETF and the healthcare ETF. So if you see investors who are looking at increasing exposure to banking or only private banks can invest in either the banking ETF or the private bank ETF. And those who are looking to increase their exposure to defensive segments of the market at these valuations, you can increase probably in the information technology or healthcare or FMCG ETF. So FMCG was something which was missing from a defensive pack in terms of our overall product bouquet, and we are very happy to add it to the bouquet. Like I said earlier, We are in the business of ensuring that whatever you need as an investor, we are able to provide you. And the FMCG ETF NFO is one such addition to our overall product bouquet. On the market cap based side, pretty much we have the Nifty, the Sensex, the Nifty Next 50, the Nifty 100, the mid cap 150, the BSE Select Mid Cap, and the BSE 500 ETF as well. In the Indian context, if you want to participate in the 500 stocks in India, then our BSE 500 ETF, which we have from an Indian context, can be a good addition to your overall portfolio for the long run as well. And along with the thematic and market cap based ETFs, we are also seeing investors being interested in the smart beta ETF space, which is the factor based investing. The slightly more evolved investors are moving towards the factor based investing, which essentially brings the best of both worlds in terms of picking a factor, selecting a stock, and then weightages of the stocks also, if they are based on that factor, then it becomes a combination which can probably suit investors for the long run. Within the factor-based ETFs, we have the Nifty Low Vol 30 ETF, the ICICI Prudential Nifty Low Vol 30 ETF, the ICICI Prudential Alpha Low Vol 30 ETF as well. These two combined, if you look at the Low Vol 30 ETF, it is focusing on the factor of volatility. These are stable stocks which have demonstrated stability in the last 1 year or so. And they are selected among the 30 stocks selected among the top 100 names in the market, and their weightages are also basis the select on the volatility. So we believe that this Nifty Low Vol 30 ETF among the smart beta ETFs is a good long-term addition to investors who are looking at smart beta ETFs, along with, of course, the Alpha Low Vol 30 ETF, where this is a combination of stocks which have generated alpha, at the same time have basically shown lower volatility. So these are, of course, on the equity side. We have a firm belief that with inflation going up and with probably liquidity being strong, investors who want to hedge their portfolio for the long run with as far as inflation is concerned and want to de-risk themselves, then probably they should also have a certain allocation to gold. Now, whether it should be 5% allocation to gold or 10%, that is something which investors can decide themselves. But the way we see it is that you must have some allocation to gold, given that gold has underperformed the other asset classes over the last many years. In fact, if I look at the last 10 years, at least in India, gold has given not very strong returns. And globally, in fact, while in India, because of rupee depreciation, gold has given some positive returns. Last 10 years, gold return in the international markets has been pretty subdued. So with the increased bout of liquidity because of central banks printing, which is happening, gold can be an asset class which can be looked at. And within that, the ICICI Prudential Gold ETFs and the ICICI Prudential Gold ETF can be looked at from an investing perspective. So we believe that from a ETF or the exchange traded fund perspective, we have a very wide bouquet to offer to all the investors. And as we believe that you should have all the options available, we are launching the ICICI Prudential FMCG ETF as well, as one of the additions to your overall portfolio. It is a segment. FMCG is a segment which for the last many years has showcased steady growth with growth in the Indian population and per capita income. And if we see over the next 5, 10, 15 years, if India's GDP continues to grow, along with the per capita incomes going up and in general, the prosperity of Indians going up, their demand for the goods and services, these basic goods and services within the fast-moving consumer goods segment, is likely to increase. And also what's happening is the larger organizations or the larger corporations, because of their easy access on the digital medium, etc., may also get a larger share of the Indians' growth. So to participate in the ICICI Prudential ETF NFO, we would recommend that please have a look at it if it fits your overall portfolio. And if it fits your overall portfolio within the basket of defensives, this is one good addition for the long term. We'd like to reiterate that investments in equity, of course, should have a long term, because the shorter term is difficult to predict what happens, because shorter term does get impacted by many factors like inflows, outflows, shorter term news. But in the long run, the companies tend to reflect the earnings. The performance of companies tends to reflect their underlying earnings growth, underlying profitability. And in the case of India, over the next maybe 5-10 years, we firmly believe the growth in the Indian underlying companies is going to be reasonably, we can be sure of the growth because of the fact that Indian population is increasing. And to participate in that, it is important to be invested in equities for the long run. Invest only that amount in equities which you may not need for the next 3 years, 5 years at least. And of course, in India, we are very underpenetrated on the equity side. So we believe that you may look at adding slowly but surely towards your equity exposure. And of course, as you gain more knowledge about your investments, you'll be able to also gain more knowledge about asset allocation and how to invest in the equity markets. With that objective, of course, we are providing the entire bouquet on the exchange traded funds for you to participate in. If you like any particular sector and it is part of our ETF segment, you can use the ETF segment to participate in that sector. So with that, I would like to say that the NFO, which is opened on 20th of July, is closing on 2nd of August. And investors who are looking to invest in it may look at investing in multiples, or minimum is 1,000 and then in multiples of 1. And it will be listed on the exchange. As you all know, ETFs are very easy to trade on the exchange, much like a share. And you can buy even a single unit. So for example, if you go to buy each of these 15 stocks, you may need a larger capital. But if you buy it in the ETF form, you buy one unit, you get equivalent proportion of those 15 stocks as it is in the index. You may get it for around 300, 400 rupees, depending on what the unit size is. So the idea is that with a smaller investment on the exchange, you will be able to participate in this 15 stocks once the ETF is listed. During the NFO, of course, it will be 1,000 rupees minimum. So with that, I'll probably end the conversation. As always, it's a pleasure to connect with all of you. Please stay safe, invest wisely. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.